REITs, real estate investment trusts, are by far one of the sketchiest investments anybody can hold through a recessionary period. And we're going to be taking a look at one of my largest holdings, Riocan Real Estate Investment Trust, which is no exception to this rule, being down 42% year to date. But you might be aware that real estate is responsible for making more millionaires than any other investment class you can get involved with. And typically in recessionary periods is the best time to pick up real estate. But unfortunately, in this recession, up in my hometown of Toronto here, real estate prices have actually gone up. But taking a look at the REIT sector, there are some major discounts. As we go back to 2008, Riocan dropped by over 50%. But this is when people turn their heads away and put these into a trash bucket, in which I have been picking up their trash. As we can see in my tax-free savings account, I currently have 374 shares of Riocan. In my managed account, I picked up 702 shares, $5,000 of which is from my line of credit. And then finally, in my Royal Bank account, I have 358 shares of this company, currently paying out a 9.8% dividend yield that it says it is not going to cut. Now, the earnings just came out for this company yesterday, and I'm going to break them down in this video along with listening to the CEO. I still think there is some incredible value locked away in this company, and I'm going to try and give you some highlights on that right now, folks. And in the clarity of my transparency, as always, I'd appreciate it. Hit the like button, hit the dislike button, helps the channel either way. But let's jump right. Investors alike to why the heck I am so bullish on this company, as we were all on the edge of our chairs yesterday looking at those earnings report to see how bad the economy truly was going to be. And yes, all of these REITs are going to be bleeding right now. There is no REIT that is an exception to that rule, but that doesn't mean if you have a long-term time horizon and you can look a couple years out from now, there's a good chance most of these REITs are going to come back, meaning that they are in pretty big discount territory right now. Now, if you've never heard of Riocan, they do have high exposure to retail, which is where all the fears around retail and office space, which we're going to get to hear from the CEO, kind of touch base on that a little bit more. This company, however, 75% of its retail exposure is to essential services that have been open through this pandemic. But one of the primary things I like most about it is that they're moving into residential and condo rental buildings. Now, this is some of their biggest investments coming online over the next 3 years, as they're expecting to have 44 million square feet of residential units coming out very shortly. In fact, one of them is just launching this year, which is called Pivot, which is actually somewhere really close to where I used to work. And this is currently 361 units that are mostly already leased out. Now, the move-in date is for fall of 2020. And I have mentioned in the past around this company that they actually liquidated so much of their retail to start investing into residential units due to the fear around Amazon. Now, really quickly, just getting into some of the presentation here to give you guys highlights of what I'm talking about here. Just taking a look at their tenant mix, 75.2% of the rent from necessity-based and service-oriented tenants, being grocer, pharmacy, and liquor stores, restaurants, and quick services. And they have other essential services. Some of the biggest hit segments obviously being apparel, movie theaters, but luckily no one tenant makes up more than 5% of their total portfolio. And I just want to scroll through here to show you guys some of the other interesting news. Now, taking a look, Q2 of 2020 rent breakdown. Now, the craziest thing is, as we move into stage 3 of opening here in Canada, which is parks and malls and other things, we can see that in the midst of May was when they were receiving their heaviest hit, where they only got 71% of rents collected. But moving into July here, they are expected to collect a total of 85%. Just scrolling through this presentation, as the CEO is going to be giving us a lot of the financial facts, I just want to show you some of the highlights that I find most interesting, which is the leading Toronto presence of any real estate investment trust right now is Riocan. And it was one of the primary reasons that I've been buying this stock, is I want exposure to premium real estate where it is likely to have the highest value, not only in rent, but in equity value over time, which Riocan has some of the largest exposure here, guys. And just scrolling down, another one of the most interesting things that I've noticed here, aside from all the projects that are coming online, which is one of the most overlooked things I think this company has going for it, is everyone thinks it is just a retail company. And yes, as of right now, the majority of its rental income comes from essential service retail, which is great. But I am more excited for these future projects of all these new condo buildings that are going to be coming online. Just taking a look at the vacancy rating across major cities from the US compared to Toronto, we can see the office vacancy in Toronto has only been 2%. The retail vacancy has been 2.7%. Residential vacancy has only been 1.5%. And just taking a look at New York, sitting at almost 8% on office, 8% on retail, and 2.8% on residential. Boston, Chicago being one of the worst, with Los Angeles here on office vacancy, guys. Like, Toronto has been skidding through this pretty comfortably, and I think that's primarily due to the fact that we are in one of the safest countries during this pandemic, and we haven't even opened the borders up yet to the US because we don't want them bringing that disease back up here, at least until there's a cure readily available. Another promising sign for this real estate investment trust here. Now, what I would like to do is a quick earnings report, but I think listening to the facts from the horse's mouth himself instead of listening to me being a third party to this company, you're going to get a little bit more useful tidbit advice. So let's get into this, and I will see you guys in a second.
This has undoubtedly been the most unusual quarter I've experienced in the over 26 years that I've been CEO of Riocan. The reasons are obvious, but it introduced a whole new issue into being a landlord, a time when some tenants simply feel they ought not to be required to pay rent, as opposed to traditionally not being able to. However, as Jonathan and she have indicated to you, I think Riocan has come through this very difficult quarter quite well from the point of view of rent collection and liquidity. Both, but particularly rent collection, because I know that's everybody's focus, during the remainder of the year will continue to get even better. This belief is not merely a hope, but is based on the actual rent collection for July at 85% of pre-pandemic rent roll. And I suspect, in fact I know, this will likely end up slightly higher as our government tenants typically pay at the end of each month rather than the beginning, but at least they pay. In addition, agreements and arrangements involving rent abatements have already been reached with all tenants of consequence and are baked into my views. In fact, my view and strong belief is that for the rest of this year, we will likely average a collection rate in the range of 90% plus of our pre-pandemic rent roll, while the actual rent collection results are, I believe, quite satisfactory considering the situation. We are certainly not satisfied with the FFO achieved this past quarter. We are quite confident that for the year, Riocan will achieve FFO in the neighborhood of $1.60 plus. This number, while perhaps higher than some analysts expect, is also not satisfactory. And we will certainly strive to do better, even this year, and we certainly have opportunities whereupon this figure can be improved. As we have said in the past, we consider our distributions a promise to our unit holders. And while the board of Riocan are, of course, the decision makers on this matter, management currently sees no reason to recommend any changes to our current distribution. In closing, I would like to differ from all the pundits who currently predict not only the death of retail, but quite a few, the death of office as we know it. What we're going through now is temporary. While no one knows exactly when it will end, it will end. When that happens, human nature, which never really changes, will require gathering places and social interactions, and Riocan owns the properties where those will occur. There will, of course, be some lasting changes, particularly the acceleration of e-commerce's share of the retail dollar. But Riocan is working on several plans to take advantage of those changes rather than suffer from them. Finally, I thought I'd throw in a word on our residential initiative. The basic premise of our building, rental residential buildings, besides the fact that we own some of the best sites in Canada for that, is that basic premise was that tenants will pay a little bit more for slightly smaller premises if the buildings are new, well-designed, have the proper amenities, gets professional management with security of tenure, and perhaps most of all, the best locations in Canada. I think Brio, as Jonathan mentioned, is such a great example of that. Bringing it to market in March, right when the pandemic started, so everything's been done virtually, and being able to have leased already, just in a few short months, 31% of the units at more or less budgeted rents that would budget we set quite some time ago, I think is a great testament to what we're doing. We're actually quite excited. Within a month, we will be launching our building called Pivot, which is at Yonge and Sheppard. Much larger building, about 365 units. And I think that once again, our basic premise on residential will be proved out.
When they go into full blast with these new projects, while also keeping their retail and residential services, something tells me that this thing is a ticking time bomb just waiting to explode. So yes, I've thrown roughly $25,000 to $30,000 at this company, in which I'm going to sit back and collect some massive dividends, over $2,000 annually in my pocket, waiting for a nice return and some capital gains, in which I probably won't sell it anyways, because trying to get to my financial independence, retire early journey in a recession, as I told you guys, will expand much faster buying into companies like this. When recessions hit, what were the best investments you could have made in almost every recession? Financials, REITs. And again, you have to do some due diligence, because if you pick the wrong ones, you don't want to own a Lehman Brothers like in 2008. But something tells me if you pick up banks right now, even though their earnings suck, again, looking 2 to 3 years out, guys, I think these are going to be some of the best investments you can make. In light of all of this, I would love to know what you guys think in that comment section below. Do you hold Riocan? And if not, what REITs do you hold? And maybe I'll break some more down in some future videos. But stay cool, stay awesome, and I look forward to catching you guys tomorrow.